Welcome everybody, good afternoon. So Christoph and I are going to split this. I'm going to speak briefly, then hand over to Christoph, and then I will take over. And then there'll be around about half an hour for Q&A after our presentations. So if I can kick off. There we go, thank you. So the first thing I wanted to say by way of framework and background is that when one considers abusive pricing practices in the energy market, we have to bear in mind two legal frameworks. The first that arises under the European Treaty and which applies to all sectors of industry. And this is found in the basic treaty provision, Article 102, which prohibits the abuse of dominant positions. It applies only to dominant entities. Dominance has to be defined in relation to a relevant market, and it condemns forms of abuse. And I'll give you some examples of the kind of conduct that is abusive. There is a defense of objective justification, which is a high test. What is important to note as well is that abusive conduct under Article 102 is typically conduct which is either exploitative of customers or suppliers, or it's exclusionary. So exclusionary has a foreclosing effect of the ability of other competitors or potential competitors to enter a market or to present effective competition on the merits, and which harms the competitive process or the structure of competition in a given market. So it tends to be, large-scale, long-running, endemic conduct. Enforcement is by the competition authorities, the European Commission, the national competition authorities, and in some member states, and that's true of the UK, where the sector regulator, Ofgem, is also the competition authority for the enforcement of Article 102 in the energy sector. And what makes all of that different to REMIT is that REMIT, first of all, it's not a fundamental treaty principle. It's created by regulation. It applies to all trading parties in energy wholesale, not only those which are dominant. So issues around market definition and dominance don't arise. It's not aimed at structural conduct which harms the competitive process. It can be aimed at individual trades or orders. And it's enforced through the national regulatory authorities overseen by ASA. As will be seen, there is some degree of overlap in the kind of conduct which could be caught by both abuse of dominance provision in Article 102 and REMIT. To give you some examples of the kind of conduct which could be abusive in the energy sector, and this list, I should say, it's not exhaustive. There is always the possibility of new forms of abuse, either in the energy sector or any other. This list, though, is based on examples from the case law, European and European Commission cases, but also national cases in the energy sector. So for strategic underinvestment, the denial of access to infrastructure or essential customer data beyond the physical infrastructure. Long-term capacity booking, which could be a refusal of supply or other restrictions on access to capacity or hoarding of capacity. Long-term supply, exclusive supply contracts could be abusive. The withholding of generation capacity. Pricing abuses, which is quite a common form of abuse and one that we will talk about more. And that could take two basic forms, either predatory prices, prices too low, or excessive prices. Discrimination and market partitioning, failure to provide technical information or making access conditional on unrelated obligations, abuse of incumbency or leveraging, or making supply conditional on the payment of invoices. So that is all really by way of introduction to the topic, and I'll hand over to Christoph, who's going to talk in more detail about what's been going on in Germany.
Yes, thank you very much, Matthew, also for the opportunity to present my part of this webinar from Berlin. Indeed, in the next few minutes, we will focus in a bit more detail on some recent discussions in Germany, and we can see them, if you like, as a case study for what might happen or what might be done in other countries as well. So to start off, I briefly wanted to introduce you to some of the discussion background that has happened prior to the very recent publication of guidelines on market abuse by the German competition authority. So these guidelines were published in September of this year. And indeed, that publication was one of the triggers to think about the design of this seminar. So the discussion in Germany actually goes back to the EU's energy sector inquiry that a lot of you will still be familiar with. That was in 2005 and 2006, which at the time generally around many European countries found high levels of concentration, especially in the electricity wholesale or generation markets. The German authorities then in 2011 followed up with their own study. So that was conducted by the Bundeskartellamt. And that study at the time found that Germany was characterized by what the authorities considered as four individually dominant companies in the market. And even at the time, the authorities established that analyzing how power plants were dispatched could be one way of investigating whether any abuse had arisen in the market. And in fact, the approach that the authorities adopted at the time in terms of defining markets and establishing who is a dominant firm and who isn't goes back to this study of 2011. Subsequently, then, in Germany, there was a political debate about the design of the electricity wholesale market, and that was conducted between 2014 and 2016, which explored the option of introducing so-called capacity markets or capacity remuneration mechanisms. And that work and the German government decided that it was sufficient to mainly rely on what's known as the energy-only market to set the right investment signals for the continued operation of power stations, but also for the construction of future power stations. And that brought about the question, how specifically then could any investor recover the fixed costs of his investment if in the end much of his revenue was remunerated through electricity wholesale markets, which may not explicitly reward capacity. And this triggered the German authorities back in 2016 to think about guidelines or rules of what type of market behavior and pricing it would consider as admissible and which it wouldn't. And as Matthew's just pointed out, the authorities have then commented on appropriate pricing principles, both in relation to competition law and also in relation to the REMIT regulation. And the German authorities came up with a similar structure or assessment as the one which was presented in the table by Matthew a minute ago. So the table you see here is one that we designed, although it really follows the text of the guidelines by the authorities. And I just want to highlight a few of the practical points which are relevant in the German case. So first of all, depending on whether prices are looked at under REMIT or under competition law, there will or there could be different theories of harm. So if we're looking at this from the perspective of REMIT, then the concern would, for example, be one of potential insider trading or of market manipulation. If we're looking at it from the perspective of competition law, then in the first instance, the question arises whether an undertaking is dominant, and then secondly, whether the prices that were charged in the market were excessive. So the important point to note is that the key concern, the key theory of harm among all the theories that Matthew alluded to a minute ago, which is of most relevance here, is that of excessive pricing, and particularly excessive pricing in connection with capacity withholding. And we'll return to the theme of capacity withholding in a minute. So this is the overall framework, and in what follows, to save on time, I will really focus just on investigations under competition law. And turning to the next slide. So this sets out in very broad terms that the German competition authorities propose to apply for any investigations of abuse. So first of all, they will establish the market situation. So they're mainly concerned about what they call scarcity situations. So those would be characterized as situations where electricity demand is relatively high as compared to the generation to be covered by dispatchable plants. And obviously a further condition for the authorities to act is that the company in question is actually a dominant undertaking. Now, I will not go into the details of the discussion of market dominance here, and I think it's a topic that Matthew will return to in a few minutes. So I'm moving further to the right, and next considering the primary abuse test. So the test that the authorities propose to apply in order to investigate exploitative abuse, and specifically the question of whether prices have been excessive, is to investigate whether plant capacity was withdrawn from the market. And this analysis would be conducted at a granularity of individual power stations or individual generation units. And whether a plant has been withdrawn either physically or in financial terms would be checked or tested based on a comparison of the deemed marginal cost of the plant that was deemed to be withheld in comparison to the day-ahead market price. So important point to note is that the key anchor price which serves as a reference is the day-ahead price, and the comparison is done against the marginal cost of a power station which is deemed to have been withheld. Now, key question then obviously is how you calculate the marginal cost of that power station, and I'll turn to some practical questions in relation to that on the next slide. And the specific or the precise wording that the authorities used, we've actually added at the bottom of that column. So they say that a necessary and sufficient characteristic of capacity restraint is the non-use of actually available generation capacity, which could have been sold at the price above the respective short-term marginal cost. So that's the real test or the condition that the authorities apply. Now, beyond that, the authorities do allow an objective justification. So there can be certain circumstances in which it would be admissible to withhold a power station even though the deemed marginal cost of that station may be below the day-ahead price in the market. In its guidelines, the authorities actually present a list of objective justifications that might be used. This list is not exhaustive, and so it will be possible that other criteria or conditions are used. So one condition is, which could serve as objective justification, is the lack of full cost recovery. The interesting point here is that the authorities are at this stage now not concerned with the full cost recovery of the individual unit, but they are then concerned with the full cost recovery of the whole fleet of plants owned by that operator. So importantly, it would focus on the whole fleet, not an individual unit. The authorities also say that there may be certain make or buy decisions which may lead a certain generator to actually leave his own plant idle and rather procure power from another operator. And the authorities explain that in this instance, they are expecting a detailed description and explanation by the company. And lastly, a further possible objective justification is that it may be necessary for any plant that bids into the day-ahead market to also provide some backup capacity to ensure that if its own plant fails, that there is another generator that can step in. And therefore, there has been a discussion around whether it should be admissible to add a risk premium for plant outage to the marginal cost of a power station. So this broadly sets out the test that the authorities want to apply. And so just to summarize some of the key points and distinguishing the abuse test and the objective justification, the abuse test is in relation to individual units and indeed individual hours, whereas the objective justification test is in relation to the whole fleet of generators. And logically, it should probably extend to the full investment horizon. So what would be the techniques that you would use either under the narrow abuse test or the objective justification? When we're in the abuse test, you would need to undertake a detailed analysis of the marginal cost of the power station in question. And potentially, and this is what the authorities have done historically, they might also use simulations of plant dispatch to check whether in certain circumstances a certain plant should have been dispatched or not. By contrast, when looking at the objective justification and the question of full cost recovery, the proposal is to look at financial analysis. To be precise, the financial analysis would probably relate to the history, but obviously if the question was whether overall you could recover your full cost, then surely the question must also be what revenues you could expect in future, which will require some projection or simulation of the future. So the data need in the abuse test is clearly you need the day ahead prices and you need to calculate the variable cost of power stations. And the challenges that arise are quite clear. So there are discussions around the specification of data, whether or not a premium should be added for outage risk, questions around the accuracy of the data, and a lot of questions around specific technical data on each individual power station. Now that describes the German approach. It hasn't been applied in this detail yet, and so what I've tried to do is to explain how it might work. But interestingly, I had a bit of a deja vu because we have actually been involved in an abuse case which followed a very similar logic, and some of you may have heard about what is known as the Lsome cases. And before I hand back to Matthew, I briefly wanted to talk you through some of the experiences from the Elsam cases in Denmark. And these cases relate back to 2005, 2006, and subsequent years. So the original situation was that the Danish generators were deemed to be strong in the market, and the authorities had initially defined a relatively soft benchmark, if you like, which was that as long as prices in Denmark did not exceed either the Norwegian prices in the north or the German prices in the south, pricing would be deemed to be okay. Although over time, the authorities then tightened the benchmark, and they said, and also applying this rule retrospectively, that actually a cost benchmark could and should be applied in addition. So the authorities developed a full cost benchmark quite related to the approach that I described to you for the situation of Germany, which was more or less that any generator should be allowed to recover his marginal cost in any hour, plus in certain critical hours, it should also be admissible to recover a certain portion of fixed cost. And the way this would be calculated is by calculating the full fixed cost of a plant and then spreading that fixed costs across all hours in a year according to a certain rule. Now, this approach was heavily contested because the authorities found that if this rule was applied, then Elsam might have abused its market position in about 10% of the hours. But it actually turned out, if you followed up on the analysis, that the result very much depended on how exactly you spread the fixed costs across individual hours. So we did analysis at the time, for example, to show that if you picked a slightly different allocation rule of how you allocate the fixed cost of a plant to individual hours of operation, you might equally end up with a view that prices weren't abusive in any individual hour. So that gives you a very quick overview of the German debate and also some of the Danish history. And with that, I'm happy to hand back to Matthew.
Okay, thanks, Christoph. Okay, I'll be very brief on the with some comments on the German work that has been going on, and then I'll talk a bit about some other cases. So first, I think what is interesting and instructive is and admirable, I should say, that Germany, the German Competition Authority and the energy regulator are grasping with this issue and attempting to provide guidance. One may not necessarily agree with the guidance, and it may not be as clear as one would hope, but I think they are to be commended for at least trying, which is not something that I'm aware any other competition authorities or energy regulators are trying to do. They also acknowledge the challenge that energy markets, particularly in electricity, are facing with the phasing out of nuclear and coal generation at a time when there is more demand, and there certainly will be more demand for electromobility, which obviously requires enormous investment. So how does one strike the balance and ensure that the right price signals are being sent to incentivize investment in new generating capacity without condemning or over-regulating conduct which might be perceived as being abusive? So it's really with that aim in mind that the Competition Authority and Energy Regulator are attempting to provide guidance which enables players in the market to differentiate between the shortages of supply resulting from price spikes, which can generate the revenue needed for investment, on the one hand, from abusive capacity restrictions deriving from capacity withholding. That said, I think what guidance has been provided is not necessarily going to be followed by either by the European Commission or by other member states. I think the way in which dominance is defined is rather unique. No reference to market share, which is the conventional measure of dominance. The statement quoted here from the consultation paper that multiple providers, each independently, have significant market power whenever their capacity is needed to meet aggregate demand, which would obviously enable the authorities to find multiple suppliers all to be dominant simultaneously, which is quite not obviously reconcilable with the concept of dominance. In relation to abuse itself, The guidance is quite controversial, I think, for difficult to apply, risks creeping into an analysis of profitability. It can be, because it's a retroactive analysis, it could be difficult to or incapable of capturing all of the price spikes that might need to be identified. It also raises questions about the extent to which full cost recovery for the entire power plant portfolio is legitimate, and what sort of risk premium can be allocated across the entire portfolio. Turning then to say a little bit more about REMIT. I'm sure all of you, or most of you, are familiar with REMIT, so just a few brief words. It's aimed at trade-based or action-based market manipulation, which involves the giving or which could involve the giving of false or misleading signals, and which influences the price of wholesale energy products so as to create an artificial price level. Alternatively, there is information-based market manipulation, resulting, for example, from the dissemination of false or misleading information regarding the availability of physical capacity, for example, using UMMs. And as I said before, there's no requirement of dominance. It applies to everybody involved in the marketplace and distribution of energy wholesale products. There is some interesting and helpful and quite recent guidance from ESA on cross-border transmission capacity hoarding. It describes how this might occur. I think in the interest of time, I will move on to the next slide, just so that I can give you a flavour of the sort of issues that have been attacked either by the European Commission or by national competition authorities under Article 102 as abuse of dominance, and then secondly, there's quite an interesting REMIT case from Spain. So I won't talk about the Lsome case because Christoph has mentioned that, but first the three other cases. First, E.ON, where E.ON was alleged to have abused its dominant position by withdrawing available generation capacity in order to raise electricity prices. What it was alleged to have done was to have withdrawn cheaper production capacity, which it owned, in order to push up the price to that determined by a more expensive plant in the merit order of supply. And because E.ON was a diversified producer, it would be able to benefit from the increased prices resulting from its withdrawal of cheaper production. Secondly, a case against Electrabel. So it was alleged here that Belgium's largest energy producer had withheld capacity between 2010. It was alleged that there were some abnormal price peaks on Belpex, which was the short-term physical power exchange. But ultimately, it was found by the authority that there was no evidence of a strategy or plan to withhold capacity to raise prices, and that there was an objective justification on behalf of Electrabel by withholding capacity in order to meet its balancing requirements. On the other hand, it was also found to have abused its dominant position by charging excessive prices in proportion to its costs for the margin scale reserve capacity. It was not found guilty of withholding capacity, but it was found guilty of charging excessive prices for reserve capacity. Third case that I was going to mention is a Spanish case involving Union Fenosa, Iberdrola, and a number of others. And they were found to have offered unusually high prices in their initial bids for the daily market in order not to be selected, so that they could charge higher prices for the market for technical restrictions, So the market for supplying electricity in particular localities because of technical system constraints on supply. And so by not bidding in the initial market, they not only increased the likelihood that the technical restrictions market would need to be called upon, but also when called upon, they were able to charge higher prices. And it was found that the yardstick for whether the prices were excessive should be based not on historical prices in the daily market, but the usual costs in the technical restrictions market. So as I said, I won't talk about Elsam because Christoph's covered that, but I would just like finally to talk briefly about another Spanish case, which interestingly was approached as a REMIT case, and a fine of 25 million euros was imposed. And what happened here was that Iberdrola had engaged in a strategy of raising prices for output from its hydroelectric plants on 3 rivers in Spain, withholding capacity, reducing its output, which was found not to be justified by any shortage of hydroelectric electric capacity. And in fact, in previous years, the volumes in its reservoirs was higher than those in the period under investigation, and that Iberdrola had actually generated more in previous years, despite having less reserves in its reservoirs. Its hydroelectric reserves didn't justify the reduction in output, and nor was there any justification in terms of expectations of future prices, because forward contracts were actually lower than those applicable in the day-ahead market. And it was found that the intention was not only to achieve higher prices, but also to encourage the entry of higher price combined cycle gas turbines during the manipulation period. And what is also quite striking is that the so-called manipulation period was only about a month, despite the very high fine that was imposed. So just finally, I think what is interesting is that there are these two branches of law that energy suppliers need to be aware of. There is some degree of overlap, but it's not perfect or complete. The Iberdrola case could arguably have been attacked as an abuse of dominance case. Certainly the conduct would strike me as abusive. Whether they were dominant, I don't know, to be honest. That the energy transition, I think it is worth saying, will require more legal certainty to produce the price signals to encourage investment that will be needed during the transition. And so with that, I think that is the end of our prepared remarks, and we're now into Q&A.
Hi, Christoph. We'll turn to you if you have any questions like that.
So as I've been speaking, are there questions that we should respond to? Maybe I'll ask Christoph.
Sorry, Christoph.
Hi.
Your mic is muted. Kindly please repeat what you just said. Yeah.
Sorry. Apologies for that. You should hear me better now. So I was just going to reply to one question that was raised by Hector Valdez. And the question was whether there are any examples where capacity withdrawal has been penalized. Maybe we can break that question down into, first of all, whether capacity withdrawal has been established, and then secondly, what the consequence of that were. So obviously Matthew's just mentioned a few cases. The Elsam case that I alluded to earlier could have potentially been such a case. So until 2016 in the appeals process, it looked like the case against Elsam or Dong would be upheld, and the case was really only finished in 2018 when the last decisions were revoked. The point is that the penalty would have arisen by private damage claims, and indeed, as far as we understand from reading the trade press, by the time and in 2016, quite a large number of private damage claims have been raised against Dong. We viewed one article, which we're also happy to share after this, which mentioned cumulative damage claims in the order of about €1 billion. And so I think from a commercial perspective, that would have been really the main penalty that would have been applied in that instance. Beyond that, the implication of the decision of the competition authorities was or would have been that the pricing behavior would have had to change compared to what it was previously. But maybe, Matthew, you want to add some thoughts on this as well?
Yes, I mean, I saw there was a related question about strategic underinvestment in capacity. And there have been a number of cases in the energy sector on this. Eni has been twice actually accused of engaging in this practice in relation to pipeline access to Italy. So both involving gas, I should say, not electricity. And so in one case investigated by the Italian authority, where Eni was planning an expansion of capacity from Algeria via Tunisia to Sicily, and it allocated capacity, but then delayed the expansion because of an expected oversupply of gas to Italy. And so it was fined a very large amount, which was reduced on appeal. And then subsequently, there was a later case investigated by the European Commission, and there was a case involving GDF in France as well, where it was found that GDF had limited investment in import capacity at 2 LNG terminals, despite the existence of a firm capacity request from a competitor. I think what these cases depend on is a finding that there is essentially a prior obligation to invest in that capacity, which the company under investigation ultimately decided not to do. So to establish that prior obligation is quite a hard thing in competition law. The concept which is most readily applicable to this is that the pipeline, or it could be an interconnector, or it could be LNG terminal capacity is an essential facility, and that because the facility, it could be infrastructure, but there are also situations where the so-called essential facility could be intellectual property rights, or it could even be customer data, but where the dominant undertaking controls that facility in a way which impedes market entry, normally downstream, and is impeding market entry in order to protect the position of a downstream affiliate, or its market activities on a downstream market. And the argument that is made is that the facility needs to be opened up, access needs to be given to it in order to enable downstream competition to take place. But it's quite a high hurdle to overcome. I think much would depend, certainly in these cases of so-called strategic underinvestment, much would depend on evidence of a deliberate strategy to exclude competition by not doing something which otherwise the incumbent dominant undertaking had previously planned to do. So it's the sort of change of course which is often the sort of the smoking gun, the evidence which allows the investigation to get off the ground. Let's see what else there is.
So I can pick up on a question from Paul Brennan. So the question was, where a capacity market is in operation, but a particular generating station does not have a capacity contract, could a failure to dispatch that generation unit be regarded as abuse? In the first instance, I would say I'm not sure it makes much difference whether you're operating in a market which has a capacity mechanism or not. The principles should be the same. So in the first instance, whether abuse could have arisen is a question of whether the operator in question is a dominant undertaking or not. And if it isn't, then abuse could not have arisen. If it was, then the test would need to be further conducted, and then we're really in the test of whether the plant was withheld, even though its variable or short-run operating cost was below the market clearing price. Obviously, a number of things need to be considered. So key question is what may have been alternative causes of the plant not being available. So, for example, was it an unforced outage, which explains why the plant wasn't dispatched? And if all these tests are not affirmative, and indeed the plant had relatively low variable costs as compared to the day-ahead clearing price, then I think we'd be in the range of thinking about other objective justifications, including the question of whether the operator overall is able to recover his total cost, including his fixed cost. In the end, the answer can't be given in abstract, so one would really need to look at each case on an individual basis. So there's also an interesting question by Amanda Spitzer, whether the public availability of data and information at a plant level helps prevent abuse of market power, or whether it actually triggers market abuse. It's a very interesting question, which has also been specifically addressed in Germany, and I believe in other countries as well. So maybe just to explain the possible logic of how being transparent could trigger market abuse. So the logic or the theory of harm here might be that full data transparency might allow certain generators to coordinate their behavior and thereby possibly coordinate a certain strategy. At least so far the theory goes. Now, because authorities are aware of this, let's say, hypothetical risk for a moment, there are actually certain limitations to data transparency and data availability. So if you look closely at the regimes in many countries, the data will not be released in real time. So there will be some time gap between the market clearing and the detailed dispatch data actually coming available. And this could be multiple weeks or it could be multiple months. But the intention clearly is to not allow generators to coordinate any strategies or any behavior by the availability of very detailed real-time information. Well, both just looking at the questions again, which keep coming in.
While Christoph's reading those, just to echo what he was saying about transparency and real-time availability of data. Certainly that is a tension with competition law, where there could well be competition law concerns around price signaling or facilitation of collusion through the publication of real-time, highly disaggregated information. Which is why there clearly do need to be some sort of controls over the degree of specificity and the timing in relation to the publication of detailed data.
So I've looked at a question or a comment from Paul Brennan. So I'm not sure I have fully understood the question, but I'll attempt to answer it. And Paul, please keep writing or mailing if we missed your main point. So again, the question is around a distinction in a setting where there is a capacity market, a distinction between existing plants or plant which operate under the capacity market and plants which don't. And if I understand Paul's question correctly, then Paul, you're implying that someone who's operating under a capacity mechanism, he might be exposed to specific license conditions that keep him from withholding power stations. And if I interpret further, your point is that someone who isn't operating under a capacity mechanism wasn't under the same license obligation. Now, my layman's interpretation as an economist, and Matthew will surely have a view from a legal perspective, is that competition law and Article 102 is applicable irrespective of whatever your license conditions are. So in that sense, competition law always applies whether you're a plant that operates with a capacity contract or without a capacity contract. What may be possible is that if you operate under a capacity mechanism, you may be subjected to additional license obligations, which may be tighter than those which are implied by competition law. And indeed, if those rules in license conditions are tighter than the general competition law, obviously there is a possibility that those conditions those license conditions are more easily breached than competition law. And in that sense, the behavioral limits are tighter on someone who operates under a capacity contract. And indeed, that in some countries that may be why policymakers have opted for capacity markets in the first instance, because it may be a way of more tightly controlling generators. But beyond that, I would say competition law applies to both the operator with or without a capacity contract.
Yeah, no, I would agree that that license conditions or regulatory obligations don't in themselves exclude the application of competition law. It would only be if there is no discretion left because of the application of regulatory obligations or license conditions, that the autonomy or the discretion to behave in a way which doesn't constitute an abuse has been entirely eliminated. Otherwise, regulatory obligations and competition law would apply in parallel.
There's also a very interesting question from Masahiro, which is that if a generator has his fixed costs covered through a capacity market, then is offering the plant above marginal cost. He says a price positioning. I presume by that you mean an action of abuse. And indeed, I would say that there can be a certain relationship between the existence of a capacity market and the question of the objective justification of prices above variable or marginal cost. So clearly, if the fixed and capital cost of a plant portfolio is to a large extent covered through capacity mechanisms, then there would be very little justification or reason for that generator to bid any of his units above the variable cost, at least when strictly applying the rules which I've just described for the German case or for the German situation. So in that sense, whether you're covered by capacity mechanism and how much of your fixed cost is rewarded through that mechanism could have implications for how you're expected to offer in the market. Though I should stress that in no instance would you be expected to offer your capacity below your variable cost. So clearly variable cost is always the lower bound.
Yeah, I saw there was a question before from someone at Ofgem about the REMIT case against NG, which involved a finding of spoofing by a trader, dates from September 2019, so recently. I mean, I have to say I don't know anything beyond what has been published said in the public domain about the case, but what Ofgem found was that there had been manipulation by placing bids or offers to trade with no intention of executing those bids or offers in order to buy or sell at a higher or lower price and increase trading profits. And it's found that that's what had happened, and that the company had some but didn't have adequate compliance mechanisms in place to prevent this from happening, and so it was fined. So I have to say I don't know anything beyond that, but it looks like a rather classic example of a REMIT price manipulation abuse.
We've had quite a few questions come in, and I'd just like to pick up one of them, which came from Amanda. So her question is actually twofold. So A, whether there are any other mechanisms for monitoring or investigating market abuse than the ones that we've described, and also how such monitoring could be applied to other markets like the intraday market, balancing market, and so on. So first of all, in relation to the question, are there other approaches that one could use? Certainly one approach that has been attempted has been also in Germany to contrast the actual dispatch of power stations with the simulated dispatch of power stations, using as much as possible the information that would have been available in real time to the real generators in the real market. This is an exercise that the German authorities conducted in their 2011 investigation, which led to huge controversies with the generators. And the key point here is that any such model that simulates plant dispatch is likely less complex and less reflective of reality than the models that the plant operators themselves use to estimate and calculate the variable cost of their power stations and therefore their actual dispatch. Beyond that, there will always be certain information which will differ between what the generators actually used and what the authorities used. So in that sense, that there is an alternative approach, but by no means is it easier. And I think the observation that the authorities in Germany have now opted for a slightly less technical approach to the investigation shows that this alternative approach of using plant simulations may just be too complex to apply in a competition law practice. Investigations have also been undertaken in relation to ancillary services markets and other markets. Again, the broad logic is very similar to that applied under, which I've described under objective justification. So in the end, it's very much a question of what are the costs, not just the short run direct costs, but also the opportunity costs, and also what are the fixed costs over the lifetime of an asset which need to be covered. And so in the end, even though if you do the investigation for a different market, like an ancillary services market, the same broad principles, I think, would apply.
I saw there was a question about overinvestment as an abuse of a dominant position. The only example I could think of is the allegation that has been made in the recent complaint against Nord Stream in relation to, well, a complaint brought by the Ukrainian company, where the allegation is that Nord Stream, by investing unnecessarily in capacity to bring gas into Northern Europe, is diverting supplies from Southern Europe. And that is, thus far, as far as I know, only at the level of a complaint. No position has been taken by the Commission. I think it's a fairly novel, difficult allegation to make. It would be a bit like predation of some sort. So predation not in the sense of, well, or analogous to the situation where prices are charged below cost in order to make it uneconomic for a competitor to enter the market or remain in the market. I suppose the analogy which is being made by the Ukrainian complainant is that by investing unnecessarily in Northern European capacity from Russia, that there is oversupply and less need for Ukrainian gas. I think it's, well, hypothetically, I can see the argument, but I think in practice, very, very hard to prove on the facts. We've only got 2 more minutes.
Maybe I can just pick up a further question from Paul, who's kindly also clarified his interest. And so it comes back to the point that Matthew addressed a minute ago of, if you like, underinvestment. So Paul has clarified that what he meant was, he was relating his question to an instance where a generator or dominant generator decides to shut down a power plant. And so the question there was in the context of capacity markets, if I understand it correctly. No, indeed, it is probably worth stressing, and maybe we haven't stressed it sufficiently in the presentation so far, that there are 2 types of situations that the authorities may look at. So one is looking at existing plants and looking at whether existing plants have been generating in all hours when prices were above their variable cost, which is one instance. And another instance is the question of whether it is an abuse to close down a power station, which might still have been operational for quite a few hours in a previous year. And Paul then raised the question in connection with capacity contracts. Now, what capacity contracts clearly do is they are likely to extend the lifetime of power stations, and thereby they would help to prevent an abuse in the sense of someone closing down a power station in order to drive up prices by more than would be required to recover the fixed costs of plant. And possibly that closure would occur if there wasn't a capacity contract. So in that sense, there could still be a policy argument for capacity contracts if they help extend the lifetime of existing power stations and thereby keep the existing markets more competitive. So that is clearly an effect of capacity markets or an effect of capacity contracts which wouldn't exist if you were operating in an energy-only market.